Hi, everyone, and welcome back to Finance in Canada, the channel where we simplify finance and help Canadians build long term wealth. If you're new here, please subscribe to the channel and turn on notifications. We cover Canadian investing, retirement planning, TFSA and RRSP strategies, and much more. In today's video, we'll explain covered call ETFs in Canada, what they are, how they work, and how you can use them to earn monthly income, especially inside your tax free savings account, TFSA. Covered call ETFs are gaining popularity in Canada. They offer high yields, lower volatility, and steady income, but they also have some trade offs you need to understand. Let's get started. Let's begin with the basics. What exactly is a covered call ETF? A covered call ETF is a type of exchange traded fund that owns a basket of stocks, just like a regular ETF. But in addition to owning the stocks, the fund manager also writes call options on those stocks. Writing a call option means the ETF gives someone else the right to buy the stocks at a set price in the future. In return, the ETF gets paid a premium. That premium becomes extra income for the ETF. This is what allows covered call ETFs to pay high monthly distributions, often between 7% and 10% annually. So, in simple words, a covered call ETF owns stocks and sells options on them to generate extra cash. Here's a basic example to explain how it works. Let's say the ETF owns 100 shares of a stock trading at $50. The fund manager sells a call option with a strike price of $52 that expires in 1 month. They get paid a $1 premium per share, so $100 in total. If the stock stays below $52, the option expires worthless, and the ETF keeps both the stock and the $100. If the stock goes above $52, the shares may be called away, meaning the ETF sells them at $52 and still keeps the $100 premium. Either way, the ETF earns income from the options. They repeat this process every month, which is why most covered call ETFs pay distributions monthly. Let's look at the benefits. Monthly income covered call ETFs generate regular monthly income, which is great for retirees or investors who want cash flow. Lower volatility. Because of the option income, these ETFs tend to be less volatile than the underlying stocks. The option premium acts like a cushion, good for sideways markets. Covered call strategies do best when the market is flat or moving slowly. Even if the stocks don't grow, the options keep generating income. TFSA friendly. Many Canadians use covered call ETFs in their TFSA to earn tax free monthly income. This is one of the most powerful combinations for passive cash flow in Canada. Now, let's be honest, there are trade offs too. Limited upside. When the ETF sells a call option, it agrees to cap the gains. So, if the stock soars, the ETF may miss out on the big upside. You trade growth for income, not ideal in bull markets. Covered call ETFs underperform in strong uptrends. If the market is booming, these ETFs will lag. Return of capital, ROC. Some of the monthly distributions may include return of capital, which is not actual income but a return of your original money. It's not bad, but it can reduce the adjusted cost base of your investment. Management fees. These ETFs have slightly higher fees, usually around 0.65% to 0.75%. That's fair given the active option strategy, but it's higher than index ETFs. Here are some popular covered call ETFs available to Canadian investors. BMO, Covered Call Canadian Banks, ETF tracks. Canadian banks and uses a covered call overlay. Great for stable income, yields around 7% to 8%. BMO, Covered Call Utilities. ETF focuses on utility and telecom stocks, known for stability and defensive positioning. Hamilton Enhanced US Covered Call ETF provides US exposure with a high monthly yield using enhanced income strategies. Riskier but high yielding. Horizons Enhanced Income ETFs. These are sector specific. CHEX is for energy, HHL is for healthcare, CHEPI is for pipelines. Each has high yield but sector risk. CI Covered Call ETFs, also sector based, including tech and financials. Similar strategy, different sectors. You can buy any of these ETFs through your TFSA, RRSP, or regular brokerage account. For tax free income, TFSA is the best option. Now, should you invest in these? If you want monthly income, if you're nearing retirement, if you're in a flat market or want low volatility, if you want to diversify your portfolio with cash flow, then yes, covered call ETFs can be a smart addition. But they're not for everyone. If you want high growth, if you're in your 20s or 30s and focused on wealth accumulation. If you're uncomfortable with options based strategies, then maybe it's better to focus on growth oriented ETFs or dividend stocks. Covered call ETFs are a great tool to earn steady income, especially in your TFSA where the distributions are tax free. But like any strategy, know the pros and cons, understand how they work, and make sure they fit your financial goals. If you found this video helpful, please like, comment, and subscribe to Finance in Canada. We post weekly content on Canadian investing, financial literacy, and practical wealth building strategies tailored to Canadians. Have questions about covered call ETFs? Drop them in the comments below and I'll reply to everyone. Thanks for watching.